Happy Monday for many macro investors. The Dow and the S&P breaking 5-day losing sessions. The Nasdaq did drop a hair, but that move today kind of goes to a trend that your next guest says may be the way forward. Looked at things outside of just tech because the market may be about to, quote, flip on its head. Savita Subramanian of Bank of America Securities joining us now. What does that mean? Flip the market on its head? Does what's working not work anymore? Does everything change? What are you talking about, Savita?
Well, yeah, no, I think that it's really the idea that a lot of the levers that have driven the S&P 500 to its, all-time highs are starting to reverse course. So if you think about it, we've had, super low interest rates, falling interest rates for a very long time, very accommodative monetary policy. We've had stimulus coming from, central banks across the globe, and we've also had no inflation. So it's been kind of a nirvana for equities, and especially for large cap tech, companies that benefit from a low discount rate. And now all of a sudden you've got inflation. You've got the Fed saying they're going to start tapering. We think it happens in November. Even if it happens next year, it's still something that I think the market is going to start to discount today. So a lot of these really kind of beneficial aspects that have driven, a tech-heavy S&P 500, a multinational heavy S&P 500 to all-time highs are reversing course. Not to mention tax reform, and I think that's the sort of the last kind of the straw on the camel's back is the idea that we're moving from an environment where the big benefit we saw a couple of years ago in terms of the corporate tax cut could potentially wipe out earnings growth for next year if you run the numbers. So lots of really positive trends for the S&P 500 are starting to reverse. That's not to say that there's nothing left to buy. We think there's still a lot of attractive opportunities, but I don't know if you're going to get the same great gains from the S&P 500. Well,
you reference it, Savita, because for a year and a half, for very good reason, by the way, we've talked pretty much exclusively about COVID and economic trends and lockdowns and economic growth and earnings. And those things still matter, by the way. Thankfully, though, COVID cases seem to be rolling over in much of the country. Goldman Sachs out with a note today saying going forward, it is going to be more likely about tax risk. We saw some details from the Democrats' plan. We're not making it political, but the numbers are in there. A raise in corporate taxes, a raise in potentially capital gains, a raise on wealthy investors as well, at least over $5 million in income. What's your take on the tax risk to the macro market?
Look, here's the bottom line. So I think that it's going to be a negative for big multinational companies because of the foreign tax component. So when we run the numbers on the S&P 500, the corporate tax hit basically wipes out where we were forecasting about 5% earnings growth next year. That goes down to 0 or potentially even slightly negative. So that's number one. Number two, if you think about capital gains, we've all, investors have made money on owning tech companies over the last 10 years. And if they're sitting there holding these companies with monstrous gains and they're about to see a potential increase in the tax rate that they're going to pay for them, one could argue that we're going to see some liquidation in some of these sort of popular individual investor stocks. So that's number two. And then I think that all of this really points to an administration that's not necessarily using the stock market as their barometer of success, but they're really using the U.S. economy. And the U.S. economy and the stock market decoupled a long time ago. Remember, we've been in this lackluster economic period, but the S&P 500 has continued to crush it. So I think that that's something else to think about, is that even though the U.S. economy is likely to be pretty strong over the next year or so, that doesn't necessarily translate into great gains for the S&P. I think it's better for the Russell 2000. It's better for sectors that would benefit from a bit of a capex pickup. But I don't necessarily think it's all roses for the S&P from here.
Hey, Savita, it's Tim. Thank you for joining us. And look, I guess the point that you've made somewhere in your notes is that you think value, at least over growth, offers more opportunity, that we're still relatively early in the run. You say 8 months. Yep. Typically, they go 33 months. So wouldn't banks be kind of the captain of that team? And ultimately, if if banks are running, the sense here is that the yield curve may in fact be steepening a bit. We've seen some of that, and that helps all industrial trades. And that sounds like a pretty big part of the market. Thoughts on all that?
I agree, but unfortunately, it's not a big enough part of the market to keep things going at the same pace. So I totally agree with you. I think that banks and industrials and some of these inflation-protected dividend growth stocks are where you want to be right now. But there's such a slim proportion of the S&P 500. I mean, think about it. The market's gotten super top-heavy in tech. And that's what I worry about, is that, a lot of what's happened over the last 10 years has basically boosted, these long duration growth stocks to be a big part of the benchmark. And now a lot of the trends that, you point out, the steepening yield curve, rates are finally doing something besides falling. That's going to work for some stocks, but unfortunately, they're not the biggies in the S&P 500. Someday they might be, but today they're not.
All right, we'll leave it right there. Savita Subramanian of Bank of America Securities. Savita, great to see you again. Thanks for joining us. Appreciate it. Have a great night. All right, Dan, your take, too top-heavy in tech?
Here's the problem that I see, and I love Savita, and I love her work, and it seems like a lot of strategists are coming to the same conclusion, that earnings growth for next year is going to be wiped out by corporate tax hikes. The problem I have, and I've been short over the last few weeks here, and I'm trying to play for just a little bit of a pullback, Sully. I don't know if you've noticed this, but these pullbacks, the peak to trough declines, are getting narrower and narrower over the course of this last year. You just look at that chart. The largest one a year ago was about 10%, and they keep getting smaller and smaller. Sooner or later, something's got to give, but it almost feels like, and I keep hearing this on Twitter from the people who love me on there, that the pain trade is higher because everyone's getting on the same side of the boat. So sooner or later, I'm just going to have to throw up my arms and do a little shruggy emoji, but I like her analysis.
I like that analysis as well. Karen, your take again. You think the market's going to get flipped on its head? One thing that Savita was mentioning we didn't have time to get to is that, for years, and I say this with all due respect for our loyal audience, you could look really smart just buying the S&P 500 ETF and making a lot of money and thinking you're a stock market pro. She's basically saying that time may be over. Stock picking, actually buying individual stocks, may be finally ready to make a comeback.
That makes sense to me, what she's saying. I mean, I have what I view as the sort of value-oriented tech names, like a Facebook, like an Amazon. Alphabet. I own Amazon and Apple as well, but the Facebook and Alphabet are the two that are really value to me. Against that, I have been short the IGV, which is the super high flyer names, and I think those are exactly the kind of names that she's talking about. If rates start to move, multiples start to come in, those are the names that are really going to get hit. So I like that. I also in industrials, which has not worked lately. I hope that it does. Names like FedEx, we'll see next week when they report earnings. So I agree with Savita. I'm sort of positioned the way she's aligning, but it's been a mixed bag for the past month or so.
It certainly has as well. We'll see if Savita's call plays out over the next weeks and months.